My 3 favorite strategies to reduce taxes from the sale of a business. You own a business. Are you selling now? Are you selling next year? Have you not even thought about the sale? Well, regardless, at some point you're going to sell. I'm going to share some valuable information, some things for you to think about now that can offset future taxes. More money for you, less money for Uncle Sam. Always a win. As we go through this, I'm going to give you some case studies, some actual client examples. Change their names, change their professions just for client confidentiality, but I'm going to show you a case study where we actually were able to save the client $1 million in taxes, in capital gains tax. If you're like me, every day you're thinking about 2 things in your business. You're the CEO, you own the business. Number 1, you're thinking about customers first, clients, members, making decisions to benefit those individuals. Secondly, you're kind of thinking about yourself. You're thinking about, how am I going to maximize my value, because someday I'm going to sell this puppy and I want to get the most amount of dollars because I put a lot of hard work into it, a lot of blood, sweat, and tears. I came from pretty humble beginnings. I didn't have a lot growing up. And when I graduated college, I decided I'm going to start a business. I was very committed to this business. And the truth is, early on, I struggled. And you probably did too. Maybe that your business was handed to you, but for most of us, we put a lot of time into this, and there's late nights and early mornings and cash flow issues. I had cash flow issues early on. I was trying to build up a clientele, and it's hard. It's hard in any business to build up clients, customers, members. I had a friend named Pete. Pete owned a commercial janitorial company, and I got to the point where I had to give Pete a call and say, hey, Pete, can I come in and talk to you? Because I have some cash flow issues. I'm committed to building my business. There's no doubt the business is going to be successful, but right now, I need a few extra bucks to make ends meet. So can I come in for an interview? He said, yeah, absolutely. So I came in, and I said, here's the deal. I need a job where I can work nights. Can I be a janitor for your company and work the night shift where no one's going to see me, no one's going to know I'm doing it? And he said, yeah, I'll help you out there, no problem. And there's a reason I share this story with you, and I'll circle back to that momentarily. Sure enough, I left that interview, Pete offered me the job, and I get in the car, and a song comes on, and the song is Rodney Atkins, If You're Going Through Hell. If you don't know the song, it goes like this: if you're going through hell, keep on going. And I remember that like it was yesterday, even though it was 15, 20 years ago. I was going through cash flow hell. I had some stuff going on in my personal life, but at the end of the day, I knew I was committed to building this business. Sure enough, it wasn't but a week or 2 later that all of a sudden some prospects of mine decided to come on board, still working with them today. And the reason I share this with you is because many years later, I had built that successful business, and I started thinking about new problems, a new set of problems. What am I going to owe in capital gains when I sell? What does that transaction look like? What if I want to bring on partners? There's a lot to think about, and there's obviously a lot of correct ways to make these decisions and execute that transaction. There's a lot of ways that we want to avoid. So I knew I needed a team to help me out with this. I have a lot of industry experience. I've helped a lot of people with business transactions, but the reality is I don't know everything. I needed a team. I have a team now. It's a team that does this stuff all day long. Business valuations, business sales, exit planning. They're great. I've gone through a lot of exercises, a lot of processes with them. I feel awesome about my exit plan and my succession plan, and I'm here to share some of the things that I've learned with you. Who am I? My name is Andrew Hoffmeyer. I am the CEO and Senior Wealth Manager of Hoffmeyer Wealth Management. It's a firm I started in 2008, which is a horrible time to start a financial firm, fall of 2008, but we made it. We're here. We're good. I own the company with my wife, Kelsey, who's the Vice President of Client Experience at the firm. She spent over a decade as a Senior Vice President at a large financial firm, and now we own this thing together. We have a lot of pride in our business, a lot of passion. Our name's on the front door, our name's on the wall. So you can bet that every day when we leave here, we make sure that we've done our very best to help people out. I'm a fiduciary. That means I put my client's best interest ahead of my own. I have a whole team. I'm a certified financial planner and certified estate planner. Last time I ran the numbers, I was the only one in Northern Colorado who holds both of those designations, and one of 8 in the entire state of Colorado who is both a certified financial planner and certified estate planner. So, all right, let's dive in. Taxes. Does this resonate? When you are thinking about selling your business, is this one of the first things that comes to mind? First question I get, how much am I going to owe in taxes? I'll give you a simple example. I'll tell you exactly how much you're going to owe. Obviously, there's a lot of variables, but if we take out all the variables, here's what it looks like. I'm going to assume you're in the highest capital gains bracket, thus you have over $500,000 in income, especially when we throw in the actual sale of the business. Being that you're in the highest capital gains bracket, that means you pay 15% capital gains plus 5% capital gains plus 3.8%. So that gets us to 23.8% federal tax here in the state of Colorado. Tack on another 4.4. Now you're at 28.2. That's almost a third of your money. If you sell for $1 million, all the intricacies of a tax return aside, you're going to owe $282,000 in taxes. For if you're in California, congrats. That state tax is up to 13.3%, which puts you at as high as 37.1%. You sell for $1 million, over a third of that gone to taxes. That's why we're here today. I'm going to show you some strategies, my 3 favorite strategies to help offset those taxes. So you have a couple options in the beginning. If you don't want to implement any strategies, that's fine. Option 1, do nothing, pay tax. That's cool. Maybe you're selling for $10 million and that's plenty of money for you and your family, and you don't care and you don't want to go through the process because it does take a lot of work to implement the appropriate strategies. That's fine. Pay the tax, go on with your life. That's the easy approach. The approach that takes a little more effort is to implement wealth strategies. And I think that's the reason you're here. We're going to dive into some actual cases, but real quick, the 3 strategies, what they are: philanthropic gifting, investment offset strategies, and opportunity zones. We're going to dive into each of those. When you implement these correctly, we see a lot of tax savings. You worked hard to build your business. Keep that hard-earned money in your pocket instead of Uncle Sam's. Some of these strategies I'm talking about, they do have some qualifications, some barriers to entry. My team can help you out there and help determine what you do qualify for. Reach out to us, hello@Hoffmeyer Wealth. We can talk through some of this with you. Additionally, we have some guides, some resources. I printed these off for you. This one over here, more of a guide, thicker packet. This one over here, checklist. They both kind of serve the same purpose. I suggest going through both of them for any business owner, whether you're selling tomorrow, next month, next year, or 10 years. Really useful exercises to go through. We also have a ton of information on our website as well as on our social. So feel free to follow us. If you want to have a conversation with us, we're happy to do that. And if we decide that we are a good fit and you qualify for some of these things, we'll actually design a customized, tailored portfolio just for you. We wouldn't just do one of these 3 tax strategies. We'd probably do a combination of all 3. And we're going to go through some examples so you can see what that actually looks like. Numerical examples. I'm going to show you how we saved a client over $1 million in capital gains tax. Do you have another video down in the description? It's more about the process, the legal, from valuation to legal document review, what that looks like. We're talking about numerical examples in this video. If you just want to know more about the process and the phases of the exit planning, click the link in the description and you'll see the other video. Number 1, donor advised funds. This is our philanthropic giving. We all know you give money to charity, there's a tax benefit involved there. Most of our clients give from the goodness of their heart, but there's also that economic benefit when you do so, that you can save money on taxes. A donor advised fund, here's why folks tend to like that, is because you get the tax, you can front load your contribution to the donor advised fund, but you don't have to decide where the money goes. Unlike most charitable contributions, we think about, we give them the money this year and it goes right into the charity. With the donor advised fund, it just kind of sits in a pool, and then we have some control in the future of where that money goes to. Had some clients come in, names were Dan and Sharon, and they owned a medical practice, and they were thinking about selling. They were in their 60s and they were making great money, and we started talking about charitable gifting, and I said, are you guys charitably inclined? And they said, well, we love helping people, but no, we don't really contribute to any charities. So we walked through that process, and ultimately we decided the donor advised fund would be a great thing for them because they were givers, they just didn't know where to give. They had a passion for helping kids and animals, and they wanted to do something on both the local and national level. So the donor advised fund made a lot of sense for them. There are IRS limits, something that people often don't know about. If you make $1 million a year, can you just donate $1 million to a charity and deduct that entire $1 million? No, you can't. There's some parameters that you have to follow. What about when you're donating highly appreciated stock or highly appreciated assets? Can you deduct that entire amount? It depends on the type of the charity, what you're donating. So we always need to make sure that we're on board. Your CPA, your accountant, your tax preparer is on board with what we're doing. We work with your team. We have tax folks on our team. If you don't have someone you work with, or we can have it be a group effort, which is what we find to be the most beneficial for our clients. Bonus before I get into my second strategy. Second strategy is my favorite strategy, by the way. Deal structure. Have you ever thought about this? If you stay on board, get some sort of retention bonus, some sort of buyout while you're continuing to work for the company, that number one is ordinary income. That will also affect the number that we use to determine the value of the business, because you staying on board is an expense, which means the company looks less profitable. Therefore, when we assign the value, the informal value to your company, that can sometimes be a detriment if you're going to stay on board. Not only that, but that's going to be ordinary income for you versus the more favorable capital gains tax treatment. All right. Case study. Number 2, this is my favorite. We've been utilizing a lot of this recently. I'm not going to go line by line here. There's a lot going on. So I'm going to make this simple for you. Here's the problem. $2.5 million tax bill because they have $10 million. This particular in this particular scenario, the client had $10 million coming in 2023 and 2024. Split up, mostly 2023, some came in 2024. I know what you're thinking. Number 1, that doesn't sound like a problem to me. But when you're giving $2.5 million to Uncle Sam, I'd argue that is kind of a problem. Number 2, you're thinking, my business is pretty cool, but it's not worth $10 million, so this doesn't really apply to you. Don't worry, I understand that. This strategy, as of the time that I'm recording this video, there's 2 different routes we take. One has a $1 million minimum, one has a $3 million minimum. It's not $10 million minimum. This is just an example of a solution we found for somebody. The solution, so the problem is $2.5 million tax bill. The solution is our Flex SMA product. Here's what it looks like. Okay, 2023, we have $8 million coming in. We owe $2 million in tax. 2024, we have $2 million more coming in. We owe another $500,000 in tax. $10 million in, $2.5 million tax bill, tax liability. Solution, Flex SMA. The way it works, we invest that $8 million and then we put extensions or overlays on it. What that does for us is 2 things. Number 1, our core portfolio, the $8 million, is designed to grow, assuming markets go up. The extensions are designed to aggressively create capital losses, not to lose money for you, but to create tax losses to offset your gain. Here's what it looks like. Little better visual. It's kind of like a hamburger, a cheeseburger, bacon cheeseburger, whatever you're into. It's almost lunchtime, so I'm getting hungry. All right, I want you to look at the one in the middle. Dark blue with the light blue on the top and the bottom. The dark blue is the initial $8 million that went into the core portfolio. We then put our overlays, our extensions on the top and the bottom. The reason we do that is twofold. Number 1, we're using leverage to get there. You're a business owner, you know how leverage works. When used properly, it can be very beneficial. You'll notice my line down the middle. 18 million of my portfolio is above the line, 10 million is below. My blue section, my buns. Bun on the top, bun on the bottom. One is a long position, one is a short position. That creates a market neutral scenario for us. So we don't really care if the market goes up or down because we own 10 million long, 10 million short. This isn't the video where I explain what owning something short means. If you want to know that, go to YouTube and Google The Big Short, Margot Robbie. She will explain it to you, and she's going to do a much better job than I could do in the amount of time that I have explaining it. All you need to know is we are trying to create a market neutral situation here. So in this scenario, over on the right, here's what happened. The $8 million grew. So we implemented this as September of 2023. $8 million in the core portfolio. Grew by 5% from September to December 31st. 5% on $8 million is $400,000. My $8 million grew to $8.4 million. What about my tax bill? Well, you can see there we generated $1.3 million in capital loss to offset our capital gain. At a 23.8% tax rate, that's a $300,000 tax savings. I understand that's complicated. Here's the takeaway. In one quarter, you made $400,000 and you saved $300,000. You are up $700,000. That's not the end of it. Remember, there was more that came in 2024. That was just 2023. So we kept the strategy going throughout 2024, created an additional offset to offset some of the capital gains, and then 2025 through 2029, there's no more capital events, no more money coming in. It all came in 2023 and 2024. So we don't necessarily need to utilize the strategy anymore, but we do have to unwind it. So we spend 2025 through 2029 unwinding the strategy. If you go back through the math there, I promised you I would show you how we saved a client $1 million between the three strategies. Well, that savings there is over $1 million just on one of my three strategies. Last one, less common, but I love this, qualified opportunity zones. You probably own some real estate, most business owners do. You've heard of a 1031 exchange. Quick explanation if you're unsure of how it works. You have a piece of real estate, it appreciated, you sell it. You would owe capital gains unless you transfer that to a 1031 exchange and buy another piece of real estate. Qualified opportunity zone works similarly in the fact that in the 1031, when you make that exchange, that transaction, you are deferring, you are avoiding your capital gains tax. The QOZ works the same way. You put your money in, whatever your capital gains due would have been, you defer it. In my scenario here, we put $2 million into the QOZ in 2023. The capital gains that we deferred, we're going to call it, to make numbers easy, $500,000. So we're not going to pay that $500,000, but we are going to pay it in 2026. That's when it becomes taxable. I know what you're thinking. What's the difference whether I pay it in 2023 or 2026? That's where strategy number 2 that I just went through comes into play. We can implement that strategy 2023, 24, 25, and 26 to offset that tax bill that we know is coming in 2026. From that point, we're going to go out to 2033, and this is where a QOZ really shines. We put the money in 2023, $2 million. Held it for 10 years, which is a requirement here. So we held it until 2033. That growth that we experienced becomes tax-free growth. Why? How can that be? Because Congress, this is actually bipartisan, which is a word that really doesn't even exist in the world anymore, bipartisan support for QOZs. You're investing in areas, think about my Colorado folks, think about Denver over by Mile High Stadium. My wife and I actually just drove through there on Monday. Used to be pretty run down, pretty dilapidated, but there's been a lot of money put into the area. I don't think that was a QOZ. Maybe it was, maybe it wasn't. But think about those types of scenarios. Rundown areas where the government has determined that they qualify as QOZs, so they're encouraging investment in the area. Well, that doesn't sound like somewhere I want to invest. I understand that. That's why we have a team, multiple layers of due diligence before we actually allow someone to invest in these areas. So let's think about this. 10 years, 2023 to 2033. We are going to, let's just use the rule of 72, which says take your interest rate divided by, 72 divided by your interest rate. That's how long it takes your money to double. So let's say we earn 7.2% over 10 years. that means our money doubled. We put in $2 million in 2023, we pull out $4 million in 2033, and we avoid tax on that because we met all the requirements of the QOZ. Super cool strategy there. I hope that was helpful. Feel free to reach out to us. I'm going to pull up my disclosures here. hello@hoffmeyerwealth.com, our website, www.hoffmeyerwealth.com, and feel free to follow us on social as well. So, hope that was helpful. Take care. Thanks for watching.